We're rolling.
Welcome to the House Dudes podcast, where we invite you to follow us on our journey towards financial freedom using the power of real estate. I'm Jack Haas.
And I'm Josh Koth. Here at House Dudes, we believe in a couple key principles. Number one, the best way to retain information is by teaching it to others. And number two, a rising tide lifts all boats. We're not competitors, we're a community. So let's get into some real estate investing.
Well, we have Chris Larsen on the call here today, and I want to call you out right away, Chris, because I know you have a podcast as well, and I want to make sure people have that information and they can find you right up front. So nextlevelincome.com, and you can find Next Level Income Show, Next Level Income on all of the social media. So make sure you look up Chris there. But Chris has been a managing partner of Next Level Income for a while, and in fact, he's been investing since the age 21. So he's got a long history associated with this, but there's going to be a lot of ground to cover. And I warned you, I have kind of some time restraints, so we're going to just jump right in. But Chris, thank you so much for joining us here.
Likewise, Jack. Thanks for having me on the show today. I'm excited.
So why don't we talk about how you got things started off here, because I understand there was a bit of a life-changing event or two that caused you to reconsider your path.
Yeah, so you mentioned the website, Jack, nextlevelincome.com. Our podcast is on there, but I also talk a lot about what we're going to be discussing today in my book, which if you're listening and you want to get a copy today, it's at the book link or nextlevelincome.com/book. And I talk about in there how I lost my father at age 5, but really for me, big shift mentally and philosophically was when my best friend died. He was 18. I was a year older, 19. It was in my freshman, sophomore year of college. And what I wanted to do then, I didn't really want to be in school. I just wanted to race my bicycle, but I was in school for engineering at Virginia Tech. We joked a little bit about kind of how boring, doing computing and different things are. And I can tell you that I went to school with some super intelligent people, and I looked around and I thought, man, I don't think this is what I'm supposed to be doing. I thought, I'm going to go race my bike, be a professional, and come back and figure out like what I want to do professionally. When my friend died, it took me about a year. I put my head down. It was really my therapy, was racing my bike, riding my bike. And I'd go ride for 2, 3, 6 hours a day. I trained up to 30 hours a week at that time. And it was very cathartic. After a year of doing that, I won my friend Chris Strader his memorial race for the second year in a row. And in pretty dominant fashion. I was in great shape. I'd moved up to a Category 1 cyclist, which once you're a Category 1, you race with the pros and you can get a professional license. And after winning that race, I came across the line, Jack, and I felt hollow. And I about a week later, I quit. And I thought, this isn't what I'm supposed to be doing. I meant to do more. I didn't know what it was at the time, but I knew that just riding my bike around in circles wasn't what I was meant to do. I needed to do more to honor not only my life, but also my friend Chris's life. I felt like I had to live 2 lives at once. And that was the big shift when I decided that I needed freedom. I needed financial independence so that when I had the opportunity to, whether it was do something exciting, like take a trip down the Grand Canyon, like I did with a small group of friends 2 years ago, where we spent almost 3 weeks in the Grand Canyon, or whether it's doing something like today, where we're going and trying to help people, learn about, financial matters, real estate, and achieve financial independence.
Right. It's shocking how many times I've had other people on the show that have stories or something that causes it to trigger this type of activity. What I think is more important is the fact that you took the moment to recognize that something needed to happen, that the change had to take place. And until you're in that proper mindset, you kind of stay with the standard quo.
Yeah. And I think, so I've done some research into this, Jack, and, it's interesting. There's a pretty high correlation between losing a parent and success in life. And what I'm kind of distilling it down, but when you're young, time is infinite. And if you can do a little bit of math, like my 8 and 10-year-old son can do that, when time is infinite, value is near zero. So if you're dividing, by an infinite number, what happens is value decreases
Right.
exponentially. When you realize that time is finite, you realize how much more valuable every day is. And when you literally see your 18-year-old best friend in front of you who just lost his life, as I did, and think, I'm already a year older than him. This could be me. Like, am I really getting everything out of my life? And then as I got older, as I had children, Jack, I just turned 42 this year. My father died at age 41. And I knew as I got closer and closer to 41, it was like I accelerated with some of the things that I wanted to do. And I tell people never let a day pass you by where you don't get the most out of it. Do your best every day. Live the most, the biggest experiences. But I think that's the thing. When you have a loss like that, it shows you that time is finite, and it makes you want to get more out of every day, whether it's a Saturday or whether it's a Wednesday.
Right. What would you say to people? You had some pretty traumatic events in your life that led you here, but I try to get it across to some people that we don't have to have those type of traumatic events to take this type of action. Like, what would you say to those people? Like, how do you get them in motion?
Yeah, so I think everybody has to operate at their own speed. You have to kind of meet people where they are, and some people are gonna have their own motivations and their own things. And I wouldn't wish upon anybody the loss that I've experienced in my life, certainly. But you can, if you need motivation, you can experience that. You can talk to people. I think the first thing is gratitude. So the great tools that I like to use is called a 5-minute journal. And I get up every morning and I say 3 things that I'm grateful for, and then 3 things that I'm excited about, and kind of get you going. And then, you can also find sources of inspiration. There's a book, and I may not remember the exact name. It's called from, I think, like Sector 15. But it's a story about a prisoner that was born in North Korea, and he was born in this concentration camp, in this work camp, and he'd never lived in the real world. And he was told a story about meat, like just like eating meat. So the only sources of protein that these prisoners would get would be rats that they killed or insects. Like that's it. They get rice to eat. That was it. So he was motivated to escape from this camp by the thought of eating cooked meat. Like that was his big thing. And like I couldn't conceptually think about that. And what they talk about in the book, that people that were put in this prison camp that had lived in the outside world would commit suicide at these astronomical rates because they knew what the outside world was like and what they were giving up. While as prisoners that were born there, they really didn't kill themselves because they didn't know anything different. And reading this book and seeing how something so small could motivate somebody, for me, it was very inspirational. But again, it illustrates the point that, if you haven't gone through these things, you may not be able to process them. But what I can tell you is, if you're listening, you have a special talent. You have the ability to get everything you want out of your life. And even if you don't know it, a lot of times like small things that you say for people can dramatically change their lives.
Go back to what you had originally were talking about too, regarding time and time being an infinite. I mean, just comparing what I was doing 20 years ago versus, spending my free time, you as your younger age, you just don't put the proper value on that time, and, throwing time away because you're playing video games or what have you, versus now I annoy my family because I'm walking around with a podcast or an audiobook playing in my pocket all the time. It's really a different, like you said, you start to see that time is not forever. I mean, you don't have all the time in the world anymore. So, it turned into a mindset piece, but and I know we didn't have you on the show for that, but I did want to talk briefly because we haven't talked about this in quite a while on the show, actually, the concept around infinite banking. And I know that you have some thoughts around that. Why don't we dive into that a little bit?
Yeah, absolutely. And it's it's a great segue if you talk about like what happened to my father or my friend. My father had some life insurance that helped provide a bit of a cushion for us when he passed away. It wasn't a lot, and one thing that is interesting is like no one ever has too much life insurance. Like that's one thing that I think really sticks out. But so the infinite banking concept is something that my wife and our family's been using for about 12 years now. It was a concept developed by Nelson Nash. And what it is, a lot of people are going to hear this and potentially cringe or be like, what are you talking about? It's a specifically structured whole life insurance contract. So a lot of people have learned, just like I did when I worked for State Farm, buy term and invest the difference. And I thought was the best way. Well, what I've really studied and learned over the last 10 years, Jack, is how do the ultra rich invest, and how do they structure their finances? And one of the secrets of the rich is whole life insurance. If you buy a whole life policy, you essentially increase your net worth just significantly the day you buy it, as long as you don't let that policy lapse. But what infinite banking is, it's a specialized structure to maximize the cash value of the insurance and minimize the insurance itself. So if you flip those around, what happens is you can actually have a insurance policy that's taxed, and you really don't want to pay tax on insurance proceeds. So if you work with a specialist, what you can do is structure these policies, and it almost acts like a Roth IRA. And the cool thing is, you can invest your money in two places at once. So actually read my book. So if you want to get the book on the website, it's chapter 3, and I talk about what I call my opportunity fund and how we structure our life insurance policies to basically accumulate cash at a rate that's faster than what you would get in the bank. So we're accumulating cash, and we're getting a return of around 4 to 6% inside of our policies. And the cool thing is we've structured them specifically so that we can pull that money out and invest it in other places. We've used it for things like buying cars. We've used it as an emergency fund. We've used it to fund syndicated deals that we've put together. And you can also use it to fund retirement, or in lieu of, say, a 529 plan for your children's education. And it's been so important for me. I've had a personal friend whose wife passed away and put these policies in place. So people will say to me, well, Chris, I can get a better return in the stock market. I don't want you to think about it like an investment. If you ask my friend what his return on his investment was when his wife passed away, he'd probably punch you in the face. Like this is insurance that has a cash component that can be used as a specific tool in your investment process. So you can check that out at our banking page. We have a white paper that we've put up there about how we use it specifically, but it's been very valuable to myself as well as a lot of my friends and the investor network that we work with.
Yeah, so if you want to get into the weeds on this, make sure you head over to nextlevel.com, nextlevelincome.com for those details. But could you go into a little bit about how this might differ from a self-directed IRA, for example?
Yeah, great question. So first off, I believe that qualified plans like 401ks, IRAs, self-directed IRAs are valuable, and they're a good place to have in your portfolio. A lot of people have a 401k or an IRA that they can't get that money out. So it's great to be able to roll that into a self-directed IRA and utilize things. So what this is going to do, it's first off, it's a whole life policy. So you're going to have that life insurance component. But if you think about it like, it's kind of like buying a house. Let's say you buy $1 million policy and you have a set premium. Let's say, and I'm just going to use round numbers. So, don't assume that these are actual numbers. But let's say, you buy a policy and it's $1 million and you put $1,000 a month in that policy. Well, that $1,000, if it's for 30 years, like a 30-year mortgage, is going to be, it's going to be consistent over those 30 years. It's never going to go up, and it's not going to go down like a mortgage. Now, in reality, there is some flexibility. You can put more or less in with a properly structured policy. But what happens is initially, that $1,000, a big portion of the first part of the term of that policy is going to be going towards the cost of the insurance. Well, after a period of time, it's going to flip. And what's going to happen is the cash value in your policy is going to go up more than $1,000 a month. just like your mortgage, at some point, if you had a house for say 20 years, 15, 20 years, your house is going to be appreciating in value, and the principal that you're paying down is going to be going up as well. So the equity that you're getting is going to be a significant portion or even more than what you're putting into it. So what's neat is, just like a house where you can pull out a line of credit, you can pull money out of these policies and put it to work. So I like to think of it kind of like real estate. So if you understand real estate and understand how principal pay down works and how appreciation works, it's very similar to how these policies work.
Sure. So can you talk a little bit then how somebody, let's walk through like a scenario on how this actually kind of works a little bit. I think it usually paints a better picture than us kind of throwing out a lot of details. So let's talk about, let's say I found a multifamily property or a REIT or something that I wanted to take advantage of, or a syndication. Like if you go, in fact, I think you have some rounds coming up, right? So if people are interested in that, go to nextlevelincome.com for those type of details as well. But how would they use this in those type of scenarios?
Sure. Excuse me 1 second. Pardon me, I had to cough there. So let's use some round numbers, Jack. So let's say you have $1 million policy that you've been funding for a period of time, and now what's called the cash value is say $150,000, and you would like to pull out $100,000 to either buy your own property, invest it in a syndication, whatever you may want. You call up your insurance company or email them, and you typically have to fill out a short couple-page form. And typically within 5 business days, that money will be in your account. They don't do a credit check. They don't ask you what the money's for. Now, they do charge you interest. So typically the interest rate in these policies, today we're looking at interest rates around 4 or 5%. So some people may say, well, that's not a great interest rate. Well, the reason the interest rates are where they are is because these life insurance companies have been around for decades, since in some cases, the ones we work with before the Civil War. They're stable. They know how to invest their money because they have to pay out when there is a loss, right? So the insurance company, that money that you pay in interest, that is part of the return that they're getting, that they're using to fund the growth so that they have that money. The neat thing is, if it's a specifically structured policy, you borrow this $100,000, you're paying $5,000 a year in simple interest. It's not compound, it's simple. You still get a dividend. So typically insurance companies are paying out a dividend around 4%. It may be as high as 5 or 6%, but let's say 4%. So your net cost of borrowing may be as low as 1%, 2%. So you borrow that $100,000. Let's say you have an investment that's going to pay you 10%. Let's just assume it's a fixed rate and you're paying 5%. So that spread is 5% or $5,000 a year. And the insurance company is still going to pay you their dividends. So let's say that's $4,000 a year. So here you are, you're getting $10,000 plus $4,000, which is $14,000, minus your $5,000. You're netting $9,000 on that. And that's why I say you can invest your money in 2 places at once, because you still have your insurance policy that's out there. The cash value will still continue to grow. And then you can also grow it in another place, like a real estate syndication or your own deal. And then when that deal sells, you can pay off that or not pay off the loan, because the insurance company doesn't care, because your policy is their collateral. So for the insurance company, it's a no-brainer. There's no safer investment. For you, there's no credit check. It doesn't go in your credit report. You are first in line to borrow that money, and you know what that interest rate is. It's not going to fluctuate by massive amounts like you may get in some other scenarios. Sure.
Is there any other reporting or regulations that people need to be aware of when dealing with this?
So not typically. The issue is if you are structuring these policies, you have to be careful about how you structure the length, the amount you put in there. So if you overfund them, what happened was back in the 80s, 70s, 80s, affluent people were putting a ton into these policies as tax shelters. So under some of the tax law that went into effect in the 80s, they have laws what are called modified endowment contracts. So laws around what's called a modified endowment contract. So basically, if you put too much money in and violate that law, what's called the 7 pay rule, or a certain amount of money that you have to put in, or less than that over 7 years. As long as you follow those rules, you're not going to have tax consequences. So you got to be very careful with that. The other thing is, if you said, oh, this is great, I'm going to go talk to my insurance agent about this. Not every insurance company can do this. So you have to be working with a mutual insurance company. So that's a company where the policy owners are the owners of the company. It's called a mutual insurance company. And it has to be what's called non-direct recognition. So what that means is, if you borrow that money out, the insurance company is still going to pay you interest on the cash value, even though you have it borrowed. And if you're saying, well, how can I pull money out and still get interest on it? The reason is they're actually taking money out of their general fund and loaning from that and leaving your cash value and your policy as collateral to use. So if you work with a group that specializes in that, as our partners at Money Insights do, they're going to make sure that all that's taken care of. You don't have to worry at all about that. But it's very efficient. There's some terrific laws in most around protections around that insurance as well. So if you're a high net worth individual, if you're a professional and you want to have money that's very secure, it's a very nice way to do that.
Sure. No, it seems like, I think I've even seen, whether it's on your website or somewhere, that when it comes to this type of thing, you would typically prefer some sort of multifamily investment, right? Like, in fact, I think I even heard you say once that it's the Holy Grail. So why don't we?
It's right on my book. Yeah. So it's right. And yeah, that's whoop. So first off, you can use the strategy that I was just talking about with infinite banking to invest in really anything, but you just want to make sure that, you have a predictable flow of funds coming in that's going to be greater than that interest rate that you're paying out. Certainly you can borrow and buy stuff, like cars and different things, and you can pay that back. But when it comes to multifamily, so in the book, I talk about why I call it the Holy Grail, and it's really based around a few different things, Jack. So one, in multifamily, you get cash flow, you get appreciation, and you get great tax benefits, all in a passive investment vehicle. I talk about how when I transitioned from single family homes into multifamily, I did so as an investor first. About 3 years later, we syndicated our first deal. We had learned and developed some relationships and partnerships in the space. But the other reason I call it the Holy Grail, if you look at it from a risk perspective, and I kind of stole this term from Ray Dalio, who he is the founder of Bridgewater, and Bridgewater Capital is the largest, and most people would say the most successful hedge fund in the history. And what Ray Dalio calls the Holy Grail is the ability to increase your return and decrease your risk. And in the book, I talk about how if you blend multifamily real estate, cash flow multifamily real estate, into a traditional stock and bond portfolio, you can actually increase the predicted return and decrease the risk of that portfolio. And there's a Holy Grail right there.
Mm-hmm. Yeah, there's a lot to unpack here. And in fact, I can't recommend it enough for people to head over to your website, that nextlevelincome.com, and get a copy of your book. I think we're just scratching the surface of a lot of this information here. But and I told you, I'm sorry, I'm on a time constraint here. So let's take a minute to kind of summarize a few of the things we talked about, just to highlight so people don't forget. First of all, we started off with a little mindset, and I think it is a very important exercise that you do. And I think you might have motivated me here to do this myself. Take 5 minutes when you get up and write down 3 things you're thankful for and 3 things you're excited about every single day. I really like that way of getting some direction for your day and a little motivation to kickstart your day. That's an awesome strategy, and if you've been doing that for a while, I commend you for it. I mean, that's awesome. It's always interesting when I've talked to people about this regarding the life insurance and the infinite banking. And we covered a lot of ground here today, but people should really consider it, especially if you have life insurance. already, there might be a way in which to either convert it or find another plan that's better suited for your investment goals.
Certainly.
And I'm sure if they go to nextlevelincome.com, is there a way to reach you and maybe even chat a little bit more about that?
Yeah, so if you're specifically interested in the infinite banking concept, Jack, we have a banking link, and we have a short video, like a PowerPoint presentation, and also a white paper on there that basically dives deeper into the concept that I discussed. And if you put your info in there, you can set up a time to have a discussion about that.
Yeah, because it's funny you mentioned, you got to make sure you find the right provider, because I've brought this up to a couple of my insurance providers, and I more than not get blank stares. They typically don't know what I'm talking about.
Yeah, it is. It's, the challenge is that, and again, this is not, this isn't saying that, one insurer is better than another insurer. It's just a specific tool. So if you go work with somebody, typically these policies, the agents are paid a commission because you're minimizing the amount of insurance and maximizing the cash value. It's kind of the reverse way of insurance. Mm-hmm. And that's what Nelson Nash kind of figured out. He hacked life insurance to do that. Mm-hmm. So you need to make sure, one, you're working with an agent that specializes in this concept, and two, you're working with a provider, an insurer that that works through a mutual, non-direct recognition.
So, and then we talked about how multifamily, you consider that the holy grail, and I really think that is your expertise, and it's something that if you really want more information around that and regarding syndications and a few other things, make sure you check out his show, and you can find that at that website again, Next Level Income. And you can find it, I think it's Next Level Show on any podcast app, right?
Yeah, we try to make it simple. So nextlevelincome.com, Next Level Income Show, and the book is Next Level Income as well.
So I really appreciate your time, Chris. This has been great, and I hope we can maybe have a time where we can talk a little longer.
That'd be terrific, Jack. Likewise.
We've put a lot of effort into providing useful content, and if you found value in the show and have any interest in supporting us with a small donation, head over to patreon.com/housedudes.
And if you have any thoughts or questions, shoot us an email at info@housedudes.com. You can also find us on Facebook, Instagram, and Twitter @housedudes. And if you like what you're hearing, head over to iTunes, subscribe, rate, and review the podcast. It really helps other investors out there find the show.
And remember, massive positive impact requires
massive positive action. We'll see you next time. This episode was brought to you by housedudes.com. Do you have time to actively manage flipping and rentals yourself? If so, go for it. If you live in a market that won't cash flow or don't have the time to do all the work, are you just out of luck? If there was a way to participate more passively, would that appeal to you? I'm sure you have questions about how the process works and what to do next. If that's the case, fill out the form on housedudes.com/investors, and we'll reach out to see if you are a good fit for our business. This is first come, first serve, and we will have to stop taking applications when our goals are met. See you at housedudes.com/investors.
I don't like to tell a man what to do with his money, but if you ain't investing in property, then you're dumber than a dummy.
I'm not dumb. I'm smart.
Well, buy property. That's my advice.